Hello, this is Michael Smith, and welcome to the Lowdown. Today, joining me is Kevin Lenox. Kevin, welcome to the show. The back half of the year, coming out of the worst year that we've probably seen for many things. You can probably start naming many of them right now, but for bonds, probably the worst year ever. Over for the S&P right now, probably one of the worst starts of the year, what, in about 40 years. And the 60-40 portfolio, right? This is where many clients, it's about 60% stocks, 40% bonds. That is the worst, I think, since the data comes out from 1976 to now, down 16%, some of the worst data. So if you're feeling a bad year, if you're just kind of thinking, wow, this is a bad half, guess what? You're not alone. Everything was probably pretty bad for the first half of the year. But now coming into the second part, the back half of the year, a lot of things have changed. And I want to point one of the things out. We've talked about the shifting that we would see, and you and I talked about in our last program, we would see a changing of the guard from inflation fears to recession fears. And I feel like just over the last few weeks, we're now starting to hear a lot of that. And there's definitely some good indicators. And I thought maybe you could share a few of those leading indicators, not the lagging, but some of those indicators that tell the investor right now that this indeed is true. We're starting to see some recession fears come into play.
Yeah, so things really changed from my framework in early May. We really saw the credit market start to crack. And with that then, financial conditions more broadly started to tighten. And that, I think, is one of the main things that would concern the Fed. Historically, they have pivoted once the credit markets seize up.
Okay.
And we look to be getting fairly close to that now. And we've gotten there faster than expected. We've seen, for example, cyclical stocks sharply underperforming defensive stocks. We've seen oil crack in a big way.
Yes.
Industrial metals, remember Dr. Copper, having a PhD
down
in economics.
33%.
Significantly. So all those things really happened at once. And I think the positive from an outlook standpoint for the second half is that the Fed may be reaching that pivot point earlier than the market expected. And we saw the NASDAQ up 2.6% today, just as a clue, versus the S&P up 1.6.
Well, and I think what was frightening is that, what we've seen as far as the Fed and what they've anticipated in raising rates, right, and tightening, is we've said that, they're going to keep raising rates. I mean, they were very apologetic here in the minutes recently about the 75 basis point increase. But if you look at what they anticipate doing, I mean, they're going to get to 4%, at least in theory. But I think what we're seeing now, and now with recession fears and what you're seeing, is that we might have reasons the Fed to start to back off. And as an investor, that's good because we've all felt the pain on the first half. We may not be seeing that aggressiveness towards the second half of the year. What are some of your thoughts on that?
Yeah, we've talked about that on the show many times. The Fed looks primarily at coincident and lagging indicators. The leading indicators and financial conditions move so much faster than most traditional economic indicators. So we're getting there fast. I'm still in the camp. The Fed's going to get nowhere close to 4%.
Exactly.
Plus $1 trillion in balance sheet reduction of the Fed balance sheet.
Yeah, so they're not going to hit what they anticipate. Well, one of the things when I first got into business, I'm talking about 97, I used to sit in a kind of a trading pit, and I remember this old crotchety guy is a bond trader, right? And he told me one day, Mike, the truth in the bond or the truth in the market is the bond market. It's 8 times the size of the stock market. It's the truth serum. What the bond market signals is what's going to happen. Don't pay attention to that equity market. And, it always stuck with me, and I've always seen somewhat the truth in that, right? And if you look at what the bond market signals, and, I have a chart we'll probably flash out here, is that the bond market, what it's telling you in terms of where rates are going, they're going lower faster than what the Fed has said they're going to basically raise rates and eventually lower them. Any thoughts on that point there?
Well, I'll go back and say the number one thing I learned from the CFA program is, to your point, the bond market, more specifically the credit markets, typically lead both the broader economic cycle as well as the stock market. And, got lucky as could possibly be in August, September of 2007, when credit really started cracking while the S&P was still hitting new highs. And I went back and dusted all that stuff on the bond market and credit, and I thought, I think this really means something.
Yeah.
And it's just cemented in my investment process ever since. I created a financial conditions index. In '07, I still use it to this day, and it has been profoundly helpful in asset allocation and risk mitigation. So the yield curve inverted again. We talked about that a few months ago. It was a flash in the pan for
very quick,
a day or two, and then it was gone, and we're back now. So
which parts of the yield curve, by the way, just
oh, sure. So the traditional one is the 10-year Treasury less the 2-year Treasury. So I always think if I'm going to lock up my money for 10 years, I should get a higher interest rate,
a yield premium,
holding it up for 2 years. So when it inverts like that, then it's indicative of a much slower path of economic growth going forward and possibly recession. So and it inverts because oftentimes the Fed hikes too much.
Yes.
The long end of the bond yield, which the Fed has zero control over from a policy standpoint, senses that, and yields come down pretty sharply, and then you get the inversion. The 10-year, 2 year is also looked at as a loose proxy for bank profitability. So if bank profitability starts to get pinched, guess what? They're less likely to make loans. And when the credit markets seize up or freeze, then it becomes a negative feedback loop into recession.
So if I'm at this aggressive Fed, I'm the Jerome Powell, the chairman of the Federal Reserve, and I've been saying we're going to be aggressive in raising rates, and now that we've seen again credit start to slow, which means businesses kind of ceasing, right? We're kind of pausing. Inflation fears have been the main driving course, but now if recession's in the cards and an inversion of the yield curve, how likely would you be to want to raise rates into that environment?
I think they will slowly get religion on that standpoint. And think about it over in Europe. I mean, you cannot have, Europe is like 23 trillion, 24 trillion dollar economy overall. They've got massive inflation problems that are going to be around for a while. And they're thinking about raising rates by a quarter point, maybe 2 hikes this year. And here's the Fed talking about they're going to 4%. That's not anywhere near sustainable or possible. Jerome Powell has a choice to make. He can either raise rates to the point to where he gets inflation down to 2%, cause a global recession. The US dollar will crush everything globally.
Which it is right now in a sense,
absolutely. Or he can back off from that and say, you know what, maybe 3.5% to 4% is okay for the next few years.
So clearly
in which case there's a more optimistic outlook.
Absolutely. Well, clearly we have, I think, a changing of narrative going into the second half. I think you and I are under the impression that we're going to see the Fed at some point probably pause. I think you mentioned the next meeting coming up that might be where we start to see at least some language. We've seen the apologies here, but let's talk about what are some of the things that we can be positioning. What should we be looking at in terms of the portfolio and construction? What are things that we can be thinking about if we start to see, I guess, a pause ultimately into a pivot?
So I'll start with what perhaps is the easier side right now, and that is fixed income, the bond market. So we're still, it's unsure which way this goes. So I will point out that the credit markets have tightened significantly over the last few weeks and did not begin to loosen until just today. That would suggest a bear market rally and expectation of a pivot versus a fundamental change coming in the economy. So I'll say that. Within that, then, a lot of people have been holding extra cash. Earned nothing, negative purchasing power. So my sense is that at this point, moving more to the intermediate term of the yield curve with more government type of securities, I think is the better place to be right now. Certainly on a risk reward, I would say, versus cash. So dry powder's starting to move into some fixed income. The call is dead wrong if one of JP Morgan's forecasts of $380 oil happens. But I think the weight of the evidence suggests now that where we are in the path that we're kind of envisioning going forward, that it's time to step back into the bond market, selectively focusing on the high quality side and more on the intermediate
So increasing that duration a little bit as well.
Correct. There's meaningful yield pickup that was not available in the bond market even just last year.
Well, what about on the equity side? What do you see as far as, again, if it goes kind of back to this narrative, inflation out of recession, but also the Fed maybe pausing to pivot? How do you see equities, and what equities you see doing well in that?
Still in the U.S. camp.
Okay.
Versus Europe. I just think it's going to be a train wreck for a long time. Just my
we could do a whole show on that, but I agree.
Yeah. Emerging markets. I thought it was pretty interesting that China announced about a $200 billion fiscal stimulus package. Yeah. They've been announcing over the last few months several monetary and fiscal stimulus measures designed to boost growth. They've sort of been in a growth recession.
Sure.
And the zero COVID policy obviously was not helpful, but they have elections coming up in October.
Yes, they do.
And they have publicly said they are going for growth now in advance of that. They don't want the growth just to start in August, September. They want to get it going now. So the part of the world where you have fiscal and monetary stimulus going in the right direction, that looks very attractive, but a lot of money will not go there while the dollar is still reaching new highs. So when there is that Fed pivot, I think emerging markets could be a huge outperformer.
Yeah, absolutely.
They're also backing away significantly on the regulatory aspect with the technology companies there.
So maybe we could see a resurface or resurgence in tech stocks could be the one that we can anticipate later on. So
potentially here, I still think the cyclicals, the value side of the equation. There's different parts of value. To be clear, the oil market was just too crowded for too long.
Yeah.
And industrial metals, and there were people there that refused to buy it in 2020, late 20, early 21, that all of a sudden became macro tourists and just had to get into oil, industrial metals. And as I think we had on a slide a couple of months ago, you date energy stocks. Don't marry them.
I know. I think that's one of the best sayings. I think we should be using that all the time.
And I think there are developing opportunities within energy now. 30% bloodbath in a few weeks gets my interest. Demand destruction is part of this for sure. But if there's accommodative Fed policy to come, they look interesting again. Certain ones, but so this is going to be, and I said it before, we are separating the men from the boys in this business.
Absolutely.
And if you don't have an investment process, which honestly most don't, most will follow consensus trades.
Well, and the difficulty is if we're going to see, I think, a recession dominating the headlines, but I think you and I reminded people over the last few podcasts is that we saw the first quarter negative decline in GDP. And if you look at GDP now statistics right now, we were at zero, I think, a few weeks ago. Now we're seeing a revision of negative 2.3 for the second quarter. Technically, we could, and the point being, we're going to be through the recession before they announce. The action, the things you should be doing is the stuff we've been talking about prior to, but not when they announce. That is a lagging indicator of all lagging indicators.
Stocks move typically 6 to 12 months before the economic data. Yeah. Extremely important to know. Most people don't do it.
So don't let the headline risk of recession drive your portfolio decisions.
Yeah. So we're going to have a technical recession here. So the Atlanta Fed is saying 2%. They just came out with that.
Yes.
So they could be off, but they're not going to be off by 2%. So does that mean sell everything, go to cash?
No.
Probably that's not the right move.
No, the move probably most likely is done. So I think going back to your advice and again getting back to staying well diversified. I mean that's one of the things we've been talking about. Higher quality, all these rotational themes that we discussed, and having that active point of your portfolio has been critical of getting through this, and will be critical going forward. We have a lot of things to go through. The world's changing quickly.
It is. So the 60-40 got smashed, but if you are following business cycle type of principles, and overweighting, underweighting the asset classes based on what late cycle / recession would indicate, come out much, much better than that. So it's important more than anything to have a process, or best yet, have an advisor that knows the process and how to allocate portfolios. And and our team here spends a significant amount of time on that.
This is what we do all day long and every day.
Yeah, some interesting discussions. We come at it from different views, but I think an advisor means more today, over the past year than it has over the prior several years. Well,
oh, yeah.
Ex-COVID.
I mean, if you think about this time last year.
60-40 did just fine from the end of the Great Recession up until COVID.
Yes.
If you just basically stuck with that, then you were fine. But significant gyrations over the last couple of years, and that probably continues. But you're right. I mean, you talked about a lot of people getting hurt in this, and a lot of good people, a lot of people just retired, close to retirement, and young investors just starting out. A lot of them going into crypto, and between Bitcoin and Ethereum had a market value of about almost $2 trillion, and now it's about $500 million. So there's a new generation of investors that just got scorched.
They just got scorched
by declining liquidity in the market. That if you were looking at it from a business cycle perspective, you would say, yeah, that and those innovative sort of growth stocks and the companies that don't make money, those that are serial capital raisers with a feeble or fragile rather business plan, they got smoked in the late stage. And a lot of people didn't get that message, and it's painful, and some people don't come back to the market. And that's disappointing.
Well, the media wants...
We try to educate people best we can.
And the media wants to make people think recessions are this terrible, horrible thing. And look, you're going to go through them. We're all going to live through several of them. A recession, I've always been told, is the natural cleanse of the system, right? The getting the excesses out of the system. In this case, you just mentioned cryptocurrency was the excesses. We talked about to our clients when they asked, well, what should I put in there if you want to go into that? We talked about 2%. If you were in 2%, you're not happy, but you're not wiped. How many people have we now heard in the media that had more than 2%? They put in an overage. And that is what happens in recessions. When you're over allocated to excessive risk, that liquidity dry up, it burns them out every single time. And that's going to happen over and over. I mean, modern portfolio theory, and Kevin, you're being part of the CFA program, Markowitz tells us the only thing that any person can do, I mean, I'm talking about all investors, the one thing you can do to help against risk is full diversification. That is the only thing out there. Market timing, all these other things you hear on TV or these other things, you might get lucky, but something that's going to really help you over time is that diversification.
Yeah, diversification, but we run core satellite.
Yes.
Here, and I'm a huge advocate of that. And it's just using the tactical portion of the portfolio, which is, generally a fourth to a third. Where you say on a risk-reward basis, we think now is an opportunity to enhance returns. Whereas you go into recession, now is a time to protect capital. So it's flexible, but if you get the calls right, good incremental return in alpha. If you mess up for a little while, it doesn't work, and everybody...
You live to fight another day.
Exactly. And it's time in the market over time, and focusing on risk management. I personally just focus so much on financial conditions because I firmly believe that and the rate of change of global growth can help you protect assets in downturns. And if you lose 25% in a downturn, it doesn't take 25% to get back even. It takes 33. And if you just got smacked in the face for 25, are you willing to take the risk to earn 33? So the core satellite is beautiful, and that it keeps you on track.
It allows you to stay in the markets and allows you to pivot. If you think about the last recession, 2008, every baby boomer, their biggest fear is a return of that. And we all know every recession's got, it's maybe similar stripes, but it's going to be different. Right. And back then, as people jumped out of the market, they got out and they thought, okay, I'm going to be cute, I'm going to get out of this, and I'll get back in. And many realized that was not true. They did not do that. And if we think about just how fast the narratives are changing, you can't afford to do that these days. The information is changing so quickly. Even if your timing mechanism was some of the best, I don't think anyone will be successfully doing that on a longer term basis.
I don't know anybody that goes from fully invested to full cash or most of the way in either direction.
Not even the best hedge funds.
And have a successful long-term record. That is market timing.
Yeah.
So adjust your portfolio incrementally based on where you think you are. Don't get emotional and don't make big bets.
All good points of advice. And you know what, Kevin, this is going to be a different second half. I think we're going to have some great conversations, but it's going to be one we're going to have to watch very closely, and a lot of changes coming up. But I
wanted to ask you, are you doing any kind of unique things on the planning side, or asset location type of deal in this environment?
Yeah, well, the planning side, I think, is one that we continue to talk to our clients about, and I think we will continue. Is if you think about what happened, I mean, we had so many things happen before the pandemic. We had the Secure Act come in, then we had the pandemic, the CARES Act. So all these regulatory changes, many don't realize, the way we want to pass our wealth maybe to the next generation, a lot of the rules have changed. And so what we've been doing is a lot of discussions on Roth conversion, so looking at Roth conversion strategies. I mean, if I tell anyone, if there's something we can't control the tax code, we all anticipate taxes are going higher. But I can tell you, when I ask any couple, how do you want to pass on, assets to your next generation? Do you want to be tax efficient? Of course, the answer is yes. So looking at Roth conversions has been something we'll continue to do. I think many see the debt that we're going to continue to take on. That's going to cost us in form of taxes later. So right now, looking at those strategies, and especially now with the markets where they are, if you're going to convert money into a Roth IRA, something that can grow tax-free for the long term, this is not a bad time to be converting assets, put it into that tax-free bucket, so you have that future upside. So definitely one I would want to consider now and not wait on.
And if there's something that you think is just deeply undervalued, that has huge upside, that's where you put that investment.
Well, and especially
if that can grow tax-free.
Yeah, and if this is an investment, is this for me? If I'm talking to a couple, and is this asset for you, or is this asset for your kids or your grandkids? Well, stop investing in that like you would for yourself. Put that into something that's more growth oriented and let it grow to that tax advantage. So definitely, lots of great conversations around planning should be happening.
Yeah, and I found too, and I knew you're in this camp too. If you do the financial plan and you keep relating to the financial plan, it helps ease customers' anxiety when they turn on the news and say the Dow plummets, 3% today, and they show the proverbial trader at his desk like this.
Yeah,
the average 401k lost $15,000 today.
And I mean, how many of your friends, and they probably do this, and they hear the market's down, and I have a friend of mine grinning, like smiling at me, as cynical as can be. How many of your clients are calling you all freaking out? And I said, you know what? Very few. And here's why. We make planning-based decisions. We already have discussions about downside risk. Not that our clients are going to quote exactly how much downside risk. They know how much downside potentially they have, and they're comfortable. So they're not freaking out when the headlines come or we have big sell-off days. They understand, and they're calm because we're making this plan and decision. So not many calls on that. As a matter of fact, even some of the reviews I've had, very little on in terms of performance. Back to the plan and making those decisions. And as a matter of fact, using that plan right now to allocate capital, as we're talking about, if we've been having some cash on the some dry powder, cash on the sidelines, or having low risk, now do we notch up some of that risk? And the plan is going to help us and determine where to put that risk. That is good planning-based decisions, and I'll do that all day long.
Yeah, and it's very important, and I know you do this, and it's a framework of my work as well, is help clients understand what they own, why they own it.
Exactly.
And connect the current market dynamics to their portfolio and the market outlook.
Yes.
So they understand that, if the S&P went down, well, okay, yeah, I've got these other aspects of my portfolio that probably did just fine.
Yeah, not everything went down.
Right.
Exactly.
But very, very important to put the two together, planning and investments.
Yeah. Well, Kevin, look, I look forward to having many more discussions. We got, again, a lot of, I think, exciting things coming up. We'll help navigate everybody through this. But I appreciate you coming on, and I want to thank everybody. Thanks for watching The Lowdown.